It's Friday, and this is your mortgage rate watch for January the 28th. We've been asked a lot of questions recently about rates stabilizing, and it would appear so taking a look at the bond page. What we've clearly defined right now is a ceiling of resistance and a floor of resistance. And what that means to current and future homeowners is that rates really can't improve to get much better. But at the same time, when we have good economic data coming out, it's not getting too much worse, which this could be a good sign. The GDP report out today with the fourth quarter rose 4.4%, which is the fastest pace since Q1 of 2006. However, it did not meet the expectations of the market, and which is causing a little bit of frustrations for Wall Street, but it has shown a little bit of improvement on the bond page for the mortgage side. With the GDP report missing expectations, even though the numbers came in higher than before, the main thing the Federal Reserve is looking at this as another leeway to pump the full stimulus of QE2 and the $600 billion into the economy. Keep in mind that their eyes, they want to increase inflation, decrease unemployment, and fuel the stock market, which so far has been somewhat successful. But the big fear here is the inflation side. Now, for all current and future homeowners, everything going on with quantitative easing 2 is extremely important as far as home ownership and where rates are going to go. Why is this? It's because of bond rating firms like Moody's coming out and saying that the U.S. debt may need to be placed in a negative outlook sooner than previously thought. And what they mean by that is possibly within 2 years. Now, keep in mind, if you have a downgrade in debt, what that means overall for the United States is that a lot of the investors will no longer invest their money into the United States market as a safe haven when there's troubles around the world, and it's no longer attractive to have a U.S. dollar as a long-term holding. And that is very critical to mortgage rates, because consider this. If you're looking at a bank and the FDIC is going to insure that bank, and all of a sudden they're going to say, we're no longer insuring it, are you going to take your money out? Yes, you would. Guaranteed you would. And with that, if you take your money out, what happens to the yields? Unfortunately, for bonds and mortgages, those yields go up, triggering interest rates to go up. Now, if this Moody's rating did come out, it would suddenly spike interest rates much higher. This is a clear sign and warning that it sends to the United States government that they have to some way unify between the two sides to come to an agreement of how they're going to control the national debt and what they're going to do to hopefully lower it. The biggest thing here is if Moody's has put out a warning and not officially downgraded, it's something that is more serious that the president is going to have to address. And with him addressing it will hopefully come with some type of plan to reduce the debt and overall get us back into the shape that we need to be in. If it's not, with a downgrade like this, you could see an instant double-dip recession possibly going into depression, because this is very serious as far as what's going on with the bond market ratings. This has a huge impact to our entire financial system, and it would be a huge detriment to the United States recovery. More to come from Homeowners Education 101 as we put the final touches on the 2011 forecast for housing and mortgage rates. Leave any comments or feedback below, as it's not only appreciated by Team Mortgage Real, but also by current and future viewers. Join the conversation on Facebook at How to Beat the Banks. Make sure when you're there, you like us. Otherwise, have a great weekend, and we'll talk to you on Monday.